We expect the global growth recovery to be uneven across sectors and regions for the rest of the year. In 2022, we will likely see a synchronized growth moderation, though still at strong above-trend pace. We believe the US, UK, Canada, and China likely achieved peak growth for 2021 in the second quarter, while the EU and Japan will likely peak in the third and fourth quarters respectively. On a sector basis, since the pandemic began, across developed countries, consumers generally substituted durable goods purchases for services. For example, sales of exercise bikes exploded while spending on fitness center memberships plummeted. Similarly, demand for autos accelerated as public transportation declined. While the above-trend pace of goods consumption was a key contributor to the overall recovery in developed markets, this growth will likely peak in the second or third quarter of this year. As the pandemic fades, we expect consumer preferences to shift back towards services spending from consumer goods. We forecast inflation in developed markets will peak in the coming months. However, the exact timing and magnitude is largely dependent on supply constraints. Some large manufacturing countries are still struggling to contain the virus, while logistical bottlenecks caused by disruption to ports and domestic transportation have also lengthened delivery times and further weigh on the supply shortage in some regions. As a result, inflation has spiked in the US and other markets. Nonetheless, we expect the supply bottlenecks to ease towards year-end as production increases, shipping congestion clears, and developed market demand shift from goods to services. We expect overall macro picture to remain positive, with growth likely to register 8% plus in GDP with benign inflation. There has been significant market concern about credit events affecting certain large entities and whether this could cause a ripple effect. We are closely monitoring those situations, since the manner in which they are resolved will have implication for how policymakers will balance systemic versus moral hazard risks. US and China geopolitical tension remain high with the G7 and NATO communique, while financial markets have been relieved by greater clarity from the US Treasury on the implementation of sanctions. Now, in the real estate market, momentum remains strong. However, robust housing demand will be partially offset by the government's tightening bias. We expect average selling prices to grow 3 to 5% year-on-year in 2021. China's resilient growth in 2020 and 2021 provided an opportunity for the government to address debt levels in the property sector. Last year, the PBOC introduced new measures, including the 3 red lines, to closely monitor and control the total debt level of major property developers. While this will create deleveraging pressure for highly levered developers, we expect the deleveraging to be orderly and controlled. Another area we are monitoring closely is green policy and its effect on commodity prices. China has made strong commitment to net zero by 2060, with near-term policies focused on reducing production in some high-emission industries, such as coal, steel, and aluminum. The Chinese government has started to use production controls and higher power tariffs as a way to lower emissions. In the near term, production constraint in China could push up prices for steel and aluminum against the backdrop of a global demand recovery and supply bottlenecks in other emerging markets. On the other hand, the renewable energy sector and new infrastructure projects will raise demand for copper, although that would only account for a small part of China's total copper consumption. Thus, the near-term commodity price dynamic will still depend on the production recovery for the major suppliers and global demand.